Hello again, everyone. As you probably know, many California homeowners face non-renewal notices, rate hikes, and difficulties securing coverage. Carrier underwriting pauses or withdrawals altogether. Um, ra- uh, Rate filings, new underwriting criteria all have driven many applicants towards the California Fair Plan, our insurer of last resort. The commissioner has introduced his sustainable insurance strategy to counter the difficulties brought on by the clash between climate change and market forces. Will it be enough? California is not the only jurisdiction with homeowners insurance availability challenges. In North Carolina, there are rate disputes with a completely different regulatory regime. Florida's Citizens Property Insurance Corporation, a public risk facility, is the largest homeowners insurer in that state. The jury's still out about the effects of the most recent hurricanes. Our panel of experts will help us understand where California is and where it's going. Here's a brief introduction of our panelists. Sharon Calls is Senior Vice President in the private client area of personal risk at NFP, an Aon insurance brokerage. Sharon is very well positioned to tell us what is happening to insureds and applicants seeking coverage right now. Sharon Taylor is Vice President of the Personal Insurance Federation of California. Sharon will provide the carrier perspective. And Lucy Wang is Special Counsel and Deputy Commissioner of Insurance for California. Lucy will help us understand the regulatory viewpoint. To set the context for our problem, I will hand it over to Sharon, who sees what is happening in the market each and every day. Sharon?
Great. Thank you. Sorry, had a little mute problem there. Thank you for having me. This is a really passionate topic for me. I run a team. We have about 6,000 clients, both on the private client group and on the traditional personal insurance group. So we see throughout California how this issue affects clients. And what I want to drive home is this insurance crisis is not just affecting people in wildfire zones, it's affecting virtually every consumer. So to give you an overview of where we are in the marketplace, just the admitted carriers that our firm deals with directly in the last 3 years, we've had 6 carriers completely pull out of the state. We've had a dozen that have paused writing any new property at all. And then you combine that with the behemoth like State Farm, and you can really see the problems consumers are having of finding options. We have 2 carriers that have restricted the number of submissions per month. They're not writing new condos, they're not writing new renters policies. And then the few remaining admitted carriers have really tightened up their underwriting. So that means some of these clients that are coming out of maybe a Kemper non-renewal or a State Farm non-renewal, if they've had a claim or if they don't have proper updating, they're not getting into some of these preferred carriers. So they're being forced into the surplus lines marketplace or into the California Fair Plan. And the toughest part is watching these clients make these extremely tough financial decisions. They're really having to look at their budget and what they can afford and what they have to do away with, quite honestly. So then we pivot to the high valued market, and that's a kind of a different animal. We're having capacity issues, and that could be because of the reinsurers. That could be because a carrier is writing too much concentration in some of these areas, like a Beverly Hills or a Malibu, where there's just a big concentration of large homes. Or it could be that the admitted carrier just feels that they can't get the pricing in line, so they're pushing coverage to their surplus lines marketplace. Then you take it a step further into the ultra high net worth valued properties, 50 million and above, and we're often looking at very complex layered programs. which is problematic because we have to look at all the contracts and make sure all the coverage is aligned. And the pricing is just absurd. That is affecting areas outside of just insurance. We've seen a huge effect on the real estate industry. We're seeing clients that can't purchase the home that they want because the insurance is either unavailable or unaffordable. We're seeing clients that are having to hold on to properties for a long time and absorb those carrying costs and often the extra cost of insurance because the house is now either vacant or the occupancy has changed. So that's kind of where we are. And where are we going? Well, the surplus lines marketplace is becoming a little bit more robust. New carriers are coming in, both on the kind of traditional under 2 million limit level and the 2 to 30 million limit level. But that's not sustainable. I mean, it's not sustainable from a pricing standpoint for the consumer. So what is the solution? Well, the solution has got to be getting the admitted markets back into the marketplace. And that's going to take rate, but rate in and of itself is not the solution. So the carriers, in my view, need to be able to be nimble in how they can underwrite risks. They need to feel that they can be profitable. They need to feel that they can be able to adjust their rates accordingly within guidelines, to adjust coverages, deductible sublimits, exclusions within reason. And that then falls into regulatory issues, which unfortunately we have an expert on the panel, so I won't talk about that. But the more we can get these admitted carriers back into the marketplace and drive that competition, that's what we need. We need a healthy, competitive landscape for all consumers.
Thanks, Sharon. It sounds like it's pretty tough. Do you eventually find a home for each risk in this market, or is it just difficult and expensive?
Honestly, we can find a solution for almost everyone. It just depends on the price. So we have seen more clients, particularly elderly clients that don't have a mortgage, make the very tough decision to go bare and just buy liability. We've also seen on the very high end side where clients have made the decision to not insure to value, which comes with its own, laundry list of issues. But they have enough equity in their home where they can afford to do that. And we've seen some very high-end homes where clients have just gone bare as well. It comes down to, a risk decision with each client.
Great, thanks, Sharon. Sarah Taylor, can you give us what carriers are saying and thinking?
Sure. So, well, David, thank you. Good afternoon, and thank you for having me and all of us here. Sarah Taylor, Vice President of the Personal Insurance Federation, and we're a trade association that represents 11 of the largest insurers in California on personal lines issues. And I want to say our members represent about 80% of the homeowners market. From our perspective, with regard to the current state of the market, clearly it seems to still be struggling. If we look at fair plan growth as a marker, it's still growing at a good clip and is even higher over the past year than it was when the crisis first started to emerge back in 2019 and 2020, where we saw the fair plan growing by maybe 30 to 50,000 policies per year. And I just looked at the stats yesterday, and over the past year, it grew by about 80,000. So with that, also the total exposure of the FAIR plan is now at almost $400 billion, when it was about $50 billion back in 2018. So that's pretty scary. Those are some scary numbers. And so absent any change, we're clearly not on a good trajectory. However, there is reason for optimism. And based on the commissioners moving forward with the sustainable insurance strategy, which I'm sure my colleague, Ms. Wang, is going to get into in more detail. But I'll just say, for background, um, that strategy was born out of some very intense discussions that occurred over the summer of 2023. And that involved the Department of Insurance, the governor's office, legislative leadership, and key stakeholders, including the industry, of course. And one of the good things that emerged from those discussions, from my viewpoint, which for the previous 4 or 5 years, I think we were all circling around but couldn't agree on, was we got a shared understanding of both the problem and the solution to help, as Ms. Calls referred to as restoring a healthy market and driving competition. And so once we had a sort of a shared understanding of the problem solution, it was really the problem generally being, climate change and the general nature of wildfire risk becoming a top tier peril. And then that, along with this outdated regulatory structure born out of, voter approved initiative, Prop 103 back in 1988, can get into that whole discussion. But really, when that came into place, there was no climate change. There wasn't even the internet. There weren't smartphones. And it was really built for a different time when things were pretty stable and not so dynamic. And so the regulatory system really couldn't respond to the new challenges that we're seeing in the market and with the changing nature of the wildfire peril. And then actually, even adding to that was the historic inflation, which I think people understate what an impact that had on driving this market crisis as well. But so the good news is that we believe the department is going to have all the regulatory changes in place shortly. Certainly by the beginning of this year, to allow insurers to use modern catastrophe models to project risk and better and more accurately price it. Insurers will now, and California was the only state that didn't allow that. California was the only state that didn't allow insurers to reflect the net cost of reinsurance in their rates. And now that's going to change shortly. We're anticipating seeing a formal proposal in November on that. And the department is really taking some proactive steps to improve the timeliness and efficiency of the rate filing and approval process, which has been a long discussed concern. They achieved an agreement with the FAIR Plan to address not only some of the operational concerns, but also better ensure the long-term financial stability of the FAIR Plan, while also putting in place really a framework that can limit insurers' exposure to a potential massive FAIR Plan assessment, given that $400 billion of exposure and that insurers, admitted market insurers based on market share, are assessed for what the FAIR Plan can't cover. And the FAIR Plan does not have much cash on hand to pay claims. So taken as a whole, these are positive steps to modernize the California regulatory structure. It provides a framework to restore market health. And, to be fair, the department is requiring insurers that want to utilize these new tools for rate purposes to increase availability in a certain set of specified counties and define distressed zip codes, which is obviously going to greatly benefit consumers when that's in place. So that's the quick version of the last 6 years of my life, trying to work towards understanding the problem and then gaining sort of a collective agreement on what the path forward is. And certainly, I think there is reason for optimism.
Aaron, I've oftentimes thought about whether or not we need a California wildfire authority to take extreme wildfire risk off of carrier books, just like the CEA does for the most part in earthquake. And so it gets carriers back in the business of writing, um, most perils, but perhaps not the most extreme perils. I'm sure the industry doesn't want the long arm of government in there, but given the nature of the risk, do you think there'd be any appetite for that?
Well, I mean, and you know, this has been coming up occasionally every year since I've been at PIF. Um, and one thing is, you know, obviously we have the FAIR plan, which in some ways is a version of that, right? So for those large fire risks, they can move off the books and go over to the FAIR plan. So you sort of have that. And it's never really been clear to me how that would work in the context of um, from the Fannie Freddie mortgage standpoint. Um, and when you look at, for example, the earthquake authority, well, it was good for removing that risk. You don't have a lot of take up. I want to say, 80% of Californians are on an earthquake fault, and only about 12% have earthquake insurance. And it's getting more and more expensive as well. So you really still haven't dealt with the affordability nature of it. The other thing, really, though, to your point, is certainly carriers have not said that wildfire is an uninsurable risk. Unlike earthquake, they were very clear it's too large when it happens, and it's a solvency level event. And that was something they were clear that they were not willing to take on. And much like we've seen with flood as well, with the federal NFIP. But with regard to wildfire, we're not hearing that. In fact, I hear the opposite. I hear it's imminently insurable. It's just, again, it gets back to having a system where that is, as Ms. Cole said, it's really flexible and nimble and allows carriers to have some confidence that they're going to be able to price it accurately, adjust in real time to changes, and be able to sort of make these proposals to the department on how they're going to take on this risk. It's often been pointed out to me that, compared to even hurricane risk, wildfire risk is not to minimize it, but I forgot the exact stat, but it was something like, you take any one of the major hurricane events, and the losses there were more than the loss of every wildfire in California just from one hurricane event. So it's a completely different level of peril and risk that you're talking about there, and carriers are still at this point feeling comfortable with that peril, as long as they feel the regulatory structure gives them the framework to adjust to it.
Got it. Well, Lucy, that sets things up for you. In a sustainable way, how can the regulatory framework support consumer interests while maintaining some availability? That's been challenging, but changes are afoot.
Yes, thank you very much, David. So I wanted to, Saren did a nice backdrop, kind of giving you an overview of kind of the regulatory changes that are afoot, but I understand that there are lots of students on this call as well. So good afternoon. I want to provide just a brief overview kind of the regulatory framework that we're referring to in terms of initiating the reform. California is what is known as a prior approval state. It is very unusual. We operate under Proposition 103, which was a voter initiative passed in 1988, and it institutes a system of rate review where every property and casualty insurer can only change its rate in California pending the approval of our insurance commissioner. And Prop 103 also created, the insurance commissioner as an elected position. His responsibility and that of the department is to ensure that insurance rates are not excessive, inadequate, or unfairly discriminatory, and to ensure that all information that is provided to the department through its rate review process are subject to public review. So this is a component that it's important to understand California's framework, because we also have to operate at a level of transparency and simultaneous complexity that other states don't operate in. So amongst this backdrop, we have not had major insurance reform in the regulatory area in nearly 30 years. And so in the last few years, we are seeing, the issues that Saren and Sharon have addressed, which is, consumers are facing higher costs and having fewer options. Our regulations are outdated. There's the growing climate threat that is not addressed. And insurers, as a result, have stopped writing and non-renewing, despite rate increases, simply because of all the other factors are in place. And then there is the increase of Fair Plan. Fair Plan can be the subject of a panel all on its own. Needless to say, I want to address the fact that while we have Fair Plan increases in California, at most it's at 3.8, 3.9% of California. We're a very large state, and we are not like Florida, where a much, much larger percentage of the Florida population is on their version of the Fair Plan, which I think is called Citizens United there. So some of the things that the department has looked at, and as part of working with the insurers and the governor's office and the legislatures, is to understand the problem and a pathway for solutions. And out of that comes this negotiated agreement where, yes, we are working industriously to improve our regulatory framework so that our regulations more accurately reflect the circumstances of today, but not without care for consumers. And Saren touched upon this at the end. So some of the things that we are working on this year is we looked at all the stakeholders in the process. We looked inward at ourselves, and to that end, we are streamlining and we are optimizing the rate application review process itself. We are staffing up. We are making sure we have sufficient actuaries and analysts to analyze the applications that are coming through. We are looking at our external stakeholder. We are looking at the insurers. It's what do we need to give them so that they can come in and give us the rate, get the rate that they need. So we are going to give them tools such as catastrophe modeling and reinsurance. And then we look at our consumers. What are they going to get? And that is, I think, one of the biggest boons and something California can do that other states cannot, which is the commitment. So to the extent that insurers are going to get the ability to more accurately have rates to increase availability and bring competitive to this market, California consumers are going to get a commitment from them that they're going to write in high wildfire distress areas that we've identified through all the data channels that we have to identify zip codes and counties where our consumers are greatest in need. And it's this alignment, not simply just providing tools for increased rate so that insurers can more accurately price their liability, but also that California consumers are going to be assisted. So it's kind of, I think in California, we've all been very eyes wide open about, we know what the problem is, and we're putting the pathway in place in terms of acknowledging it and getting it there, and then we will see what happens. And Saren touched upon the different reforms. So, we looked inward at improving and streamlining our own review process, new risk catastrophe modeling and reinsurance. One positive aspect of all of these is the fact that certain things that we are already doing in California, such as consumers and communities are already engaged in mitigation efforts and home hardening. Those are things that will be recognized within a catastrophe model that isn't being recognized now in the current system. So again, these reforms really do build upon and strengthen, the existing pathway that California is already on in terms of, updating its regulatory framework to acknowledge, the increase in climate change and where we are at. And then in terms of, strengthening the FAIR Plan, Saren has touched upon that as well. We are looking at the FAIR Plan, making sure that we can move, parties that are in the FAIR Plan because of lack of availability, moving them back into the admitted market. So all of these things have been, happening throughout the department this past year. And so it's been a tremendously interesting time, and it's exciting. But most of the reform, the regulations will be in place by the end of this next year, and the hope is January 1st, we're open to to business, and all these regulations will be in place, and then it's going to be upon the insurers to make use of those policies, and then hopefully by mid to end of 2025, consumers will start seeing the benefit of those.
Lucy, are these changes, sufficient changes, possible while also staying within the boundaries of Prop 103?
That is so good, David. So, they all are. And I can say this because as the individual who has led all of the efforts to ensure that we had many stakeholder public meetings, first and foremost, because Prop 103 requires all rate application processes to be subject to public review and public participation, we have ensured that all of the procedures and the reforms that we have set in place meet that transparency and public review requirement. So yes. So for example, to the extent that we are going to implement catastrophe models, we have established a review process for those models where everyone can participate in that process. And we are, it's called a PRID determination. And the point of it is to ensure that, that the models that are being used in rate applications are done with integrity, and everyone has the opportunity to vet that. And so once that model has been reviewed and has achieved that determination, then it will be incorporated into a rate application.
Yes, Glenn in the chat read my mind. The intervener process, for those that know about it, it sounds like a good idea, but Consumer Watchdog might not be as pure of heart as we might have thought. The question is whether or not the intervener process is in the way, I suppose it's required by.
So Glenn, you must work at the department, or no? I go, this panel isn't as unsophisticated as I thought. So one component in California as the public participation component is that interveners are allowed as part of the process. And I think they're an important part of the process. The intention is not that they hold up the process. It's just one more check on the system to ensure that, on behalf of California consumers, that everyone is operating with utmost integrity. But to the extent that, things have been business as usual in the past, that is also an element of the process that the department has taken a look at in terms of, when a rate application comes in and the insurer comes and says, department, here are materials, we would like this rate increase. Interveners, public participants are allowed to then come in at that point and also participate in that process to say, oh, we think that, your documents do support the rate change, or we think the alternative. And that's called interveners. And so to the extent that interveners come in, there are instances where it causes delay because you have another person in the room saying, hey, please prove that, your application is supported. So in the past, we haven't had the same number of applications that we've had, and we haven't had the same level of interest. But in the last 3 years, everything has just come to a head, both in terms of, the amount of applications the department has received, the number of interventions that's happening, and it all increases to delay. So as part of this process, the department has also taken a look at intervener participation and making sure that when intervention happens in a rate proceeding, that they are only coming in and only addressing issues that are relevant and at play in an application. So for example, if an application comes in for a rate and a public wants to come in and just hunt around on a fishing expedition for other issues they may or may not have with this particular insurer, we're no longer going to let that happen. It's like, let's focus on the issues that are in this application, and then we're moving on. So things that there was more room for give in the past, we're just more focused now. It's really, interveners and public participation, it's part of the law, and I think it's a positive aspect, but everything just has to work in a more optimal manner. And I think that's what we're really focused on.
Right. So Sharon, you mentioned some insureds eventually decide as a financial decision just to go bare or not to insure to full value. Most of the things I'm hearing are not likely to reduce rates. And it may be that we've just enjoyed an underpriced market for a very long time. Will it just require consumers a period of time to get used to this higher cost of insuring their home, or are those people going bare gone for good?
I think it's a combination. Certainly the financial aspect of it comes into play for certain clients where they've just hit a threshold where they can no longer afford the products that are available. But I also think there's been clear decisions made when the product that is available is so substandard that they feel that it's not worth the price. And for those consumers, I believe if other companies come back and the pricing is still that high, but it's a traditional product where they feel there's value there, I think we'll see those clients come back.
Can you elaborate a little bit on the substandard product without naming names?
Yeah. There's products out there that because of their limitations, it causes the client to be underinsured, causes the client to have actual cash value versus replacement cost, eliminates coverage other than the dwelling. So you lose personal property, loss of use, etc. Limited perils. So it's large wildfire deductibles, water limits, sublimits. I mean, there's all kinds of kind of tactics right now that, particularly on the surplus line side, where they're implementing ways to try and manufacture a product that they feel comfortable with, and it's not necessarily of value to the client.
Got it. So, Saren, I know that the final grand bargain that will hopefully be in place by the end of next year isn't fully, finalized. Is there a point where the industry tries to use its muscle, as has been accused, where it uses its muscle to storm away from the table and say, it's not enough. We are still going to lose money at that rate or on these terms. We don't want to be here anymore. And because the industry has been accused of trying to pressure regulators in the market for more rate and using availability as a weapon.
Well, yeah, I mean, well, I think it's important. I mean, I think I know who's making that accusation, and it's the same, and didn't know if you wanted to have a conversation about the interveners, but certainly it should not go unnoticed that the people who wrote Prop 103 wrote in the intervener process, and they now account for 90% of the interventions, and it's a whole business model for them. And ultimately, I think it hasn't worked out well for the consumer based on the way things are. So, but I don't even think that's a fair accusation. I don't think these carriers by any means have. Yeah, I always say if they could go back to 2016 and earlier and not have inflation and not have wildfire losses where whole towns are being wiped out, everyone would gladly go back to that and keep Prop 103 the way it was, and we'd happily just keep muddling along. So this was by no means insurers are gaming the system. This is a genuinely companies had and the numbers are the numbers. You can look at the Department of Insurance numbers. You can look at the National Association of Insurance Commissioners numbers. There's no question about the loss ratios that these carriers were experiencing, losing $2 for every dollar of premium they were taking in. whether you look at it over the past 5 years, the past 10 years, 100-year-old ratings companies like AM Best, putting the entire homeowners market segment from stable to negative. I mean, the losses are very real, and the companies are feeling it. So there was no flexing of muscles to get something here. This is just a pure necessity to make changes so that things can function. And I don't see any indication that anyone is saying we're going to walk away. I've not heard anyone say that what the department is putting forward with these reforms, we're going to walk away unless we get more. That's never come up. I mean, certainly, we have public comments on the regulations. There's things that we would like different. And I think, as the commissioner has publicly said, there's an element to this where I think collectively we're all sort of building the plane while flying it. And so there's things that are going to have to be figured out along the way and how they're going to operate. One being this PRID process that Ms. Wang referred to. It's never been done before. So, how's it going to go? And there's an intervener element to that. But no one is looking at this like, this is so bad and so problematic, there's no way, and we're going to walk away. It's all the key pieces are there, and now it's just going to be putting it into practice and how is it functionally going to operate. And we're going to find out over this next year. And and just like there's pressure on the insurers now to deliver under the new reforms, there's also pressure on the department onto how they're going to choose to implement it in a way that's going to, and I believe they want us to succeed, just like insurers wanted to succeed, just like consumers wanted to succeed. So hopefully there's going to be, hey, let's think about if we hit a hurdle, then we're going to try to think collaboratively about, okay, maybe that's not working the way it was supposed to. Let's fix that. But I think everyone is committed to making this process work. I haven't heard anyone suggest, sort of this idea that we're going to walk away and come back to renegotiate this or something.
Right. Lucy, this has been on the marketplace's mind for a while now. When do you expect it to sort of be finalized and then implemented? And what does the implementation or the approval process for that look like?
So I love this question. So this is what I work on every day. So now that we are 3/4 of the way through this year, most of the major regulatory work, but we're not completely done, is well underway. So for now, my daily basis, it used to be all about drafting regulatory text and meeting with stakeholders, and now we are really focused on the implementation. So Saren touched upon it. I mean, there's different components of the regulatory text. One was the streamlining of our rate application process. The one that we're focused upon now that will be next in line to be submitted to the Office of Administrative Law is our catastrophe modeling and rate making regulation. And the third is reinsurance. And as part of that catastrophe modeling, this is the first time California is going to be reviewing models. It has to be done pursuant to public review because of Prop 103. And we have set up something known as the PRID process to kind of look at models. Now, the PRID process is not designed to make sure that the model, I always how I explained it to people is we're not trying to divine the formula for Coca-Cola, but we're trying to make sure that the ingredients of Coca-Cola don't kill us. So for example, it's not our job to go in and a modeling company comes in with their model and we want to figure out how they put it all together, but we want them to come in and we are going to, kick the tires around and say, well, we have these preset data sets and we want you to run it and we want to see how that looks. We want to make sure your model was put together with accuracy. We want to make sure it's put together with integrity. And so everyone's going to have the opportunity to examine the model, run their data sets, ask questions about, how did you set the parameters for that? Where did you go to do that? But it's not our job to put the model together and try to divine their proprietary formula for doing so. So I anticipate this is a process that, is going to take a little bit longer than probably what we think the first few, because let's be honest, the first time you do anything, it's always going to take a little bit longer. But it's something that I see ultimately being just a couple of months, because it should all go smoothly. Everyone comes in, everyone looks at the model company has to justify and answer everyone's questions, and then we just move along. Because even though the model is approved, an insurer still has to incorporate the model along with the rate that they're requesting as part of the rate application process. So, to the extent that some people think that it's an automatic gateway, like, oh, if you're going to allow use of models, it's going to lead to increased rate. I don't think that's necessarily true. The review of the model is one thing. The incorporation of the model and whether it supports the rate that the insurer is asking for is another part. And if anything, what I tell people is catastrophe modeling is taking into account things that currently aren't looked at, such as mitigation and community, home hardening. Like those things aren't accounted for in the current process, and they should be accounted for because communities are spending a lot of money and people are spending a lot of money mitigating their harm.
Right.
So
Well, Sharon, I'm going to
hopefully, I want to let Sharon speak, but so hopefully by mid to end of next year, 2025, we want to see these, come in place. But again, people who want more detail than that, I always say I need a crystal ball because we're putting everything in place. One thing I just want to touch upon what Sharon said is the reason no one has said they're going to walk away or we're going to walk away from the table is because the department has worked so hard to reach out to all stakeholders in this process. What I tell people is, we're planning a party and we've talked to all the participants as to what they want out of this party. So when this invitation goes out January 1st, we're open for business. We want everyone to show up. And that's not just the insurers. We've talked to the modeling companies. We've talked to all the consumer groups. And we've let everybody know, what's your input? This is what we're going to do. This is how we see it moving forward.
Great. Thank you. So Sharon, I'm going to give you the last word. I was, pleased to hear that almost every, and that was I think almost every applicant is able to find a solution in the marketplace. Meanwhile, I would imagine between now and the time that the marketplace is able to heal, that you're going to continue these difficult conversations and let's call them patchwork solutions. Can you tell us a little bit about those solutions? Is it all excess and surplus lines market? Is it, crazy high deductibles? What sorts of risk financing arrangements has the market developed to bridge the gap?
That's a great question. And it almost depends on what segment we're talking about. There seems to be more viable solutions in that kind of under 2 million replacement cost home. There's surplus lines carriers that have come in. There's still a few admitted markets, whether it's an admitted market that we have or some of the direct carriers like the Auto Club, Farmers, they're still writing certain properties. So there are still more solutions at that level. It gets a little tougher at the higher levels. And we've had to do, a combination of California Fair Plan and a difference in conditions and an excess wildfire and, kind of cobble programs together to meet not only the client's needs from possibly a lender standpoint, but also from a balance of what they're willing to spend versus what they can get for that spend. So there have been new products that have come out, like some excess wildfire programs. We sometimes have to carve out the personal property onto a personal property floater policy. So you can kind of wind up with this like Frankenstein program that started with one policy. And you know, I don't want to forget about the consumer. This is all so stressful to the consumer, not only the pricing, but just this is a whole new level of education. You know, before they knew what a homeowner's policy was and they knew what it did and they knew what to expect when they have a claim. And now you don't, because as you alluded to, we're having not only higher deductibles, but different deductibles. We're having pressurized water deductibles. We're having wildfire deductibles. So it's a whole new education process that we have to go through with these clients.
Great. Well, we'll end on that note. So Sharon, Sarah, and Lucy, we really appreciate the up to the minute view of the marketplace and where it's going. I think for those who stayed to the end in the afternoon, we really feel better educated that, as Lucy said, by the end of next year, we'll finally be in the place we need to be.